Good morning, everyone. Thank you very much for coming to today's special seminar. I don't know who picked Friday the 13th for this. If you've just seen us scrabbling around, my laptop died, so hopefully we've already had the one disaster. On that note, there was also a notice in reception that there'll be a fire test at 11:15. That's actually been moved to 1 o'clock, so if the fire alarm does sound, assume that's actually not a drill and we should all get out. So we haven't done one of these sort of long-form seminars for quite a few years now. We've been doing more sort of small, short-form breakfast seminars, which have been really popular. But the amount of changes that there were at the last budget, we felt warranted spending more time, and we've had really, as you can see, great take-up. We've got, I think, 100 plus people here today, so hopefully you'll get something out of it. It's very much about us sharing our own experiences of things that we've thought about after the budget. So a lot of the examples that we're talking about are actual cases that we've dealt with. But it's still an evolving picture, and certainly on things like the inheritance tax rules, we don't actually fully know yet how they're going to operate. So this is very much our thoughts on what we're doing with our clients, and hopefully there might be something that rings true with your own clients. So in terms of the format this morning, I'm going to take the first half and look at the changes to capital gains tax and what that might mean for people when they're setting up companies or restructuring. Then we'll have a break at 10:30, and then in the second half we've got two talks by my colleagues Adam Sedgwick and Laura Hutchinson dealing with the changes to inheritance tax. So what were the main changes that were announced at the October budget? Most people will be aware of these. I think the three main ones are national insurance increase, capital gains tax and inheritance tax. We're going to touch very briefly on national insurance, but we're going to focus today mainly on the capital gains tax and inheritance tax increases. So we're looking at the implications for business owners and families and what they might want to do moving forward. So I'm just going to very briefly summarise the main changes, what has and hasn't changed. So national insurance contributions, the employer's NI has been increased from 13.8 to 15%, and that was from 6th of April this year. That was combined with a reduction in the secondary threshold. That's the point at which employer's NI kicks in, which was reduced from 9,100 to 5,000. To sort of temper the increase, the government did increase the employment allowance. So this is sort of the amount that employers can accrue in national insurance without having to pay it. There is a mistake on this slide. It's 5,000 to 10,500. It was capital gains tax. We had an increase in the main rate on budget day, so it went up from 20% to 24%. At the same time, there was an increase in the basic rate. That's for people to the extent they've not used their basic rate income tax allowance, and that rate went up from 10 to 18%. There wasn't any change in the rate applicable to residential property disposals, which had been at 28%, but the Conservatives at their last budget brought down to 24%. So for UK residents, the rates are now aligned across the majority of assets at 24%. Business asset disposal relief. Well, this has already been attacked by the previous government quite severely. So at one time, this was a £10 million lifetime allowance, and it allowed people, when they come to sell their business, to qualify for a 10% rate of tax. Well, the previous government brought the lifetime allowance down to the £1 million limit. We thought they might abolish this completely, but what they have done is just increase the rates. So from this April, it's gone up from 10 to 14%, and it's going to go up again to 18% from next April. Investors' relief, that's a relief, operates in a similar way to entrepreneurs' relief, but as the name suggests, it's targeted at investors rather than employees and directors that work in the business, albeit there is an ability for some directors to qualify. Oddly, the previous government, when they attacked business asset disposal relief, didn't touch investors' relief, and so we did have a £10 million lifetime allowance for that relief, but that's now gone down to £1 million. And likewise, the rates have gone up in line with the BADR changes. Inheritance tax, this has probably been the most widely publicised, particularly because of the uproar amongst the farming community. The main change here is that business property relief and agricultural property relief, which previously applied to 100% of assets that qualified, that's now only up to £1 million. So anything over that, you're getting a rate of 50%. In addition, unpopular probably with majority of our clients is that pensions are going to be brought within the scope of inheritance tax from April 2027. We're not going to touch too much on that today, but just bear in mind that when you're looking at anyone's estate, you've got to think, well, in 2 years' time, that estate could be much higher because of this change. There was, oddly, widely speculated that the government might attack the capital gains tax uplift that you get on death. So if you pass on assets, your beneficiaries inherit them at their market value at death, but the government didn't change that. And then finally, there's been a replacement of domicile as the defining factor as to whether someone's subject to UK inheritance tax. That's been replaced with a new residency-based test. So I'm very briefly going to touch upon employers' NI. I say briefly because I think most people know the impact of it and how it's affecting companies. But a question that we do get a lot is, if you're an owner-manager, what should you do in terms of your own remuneration from the company? I.e., should you take salary or dividends? This table here just summarises the position before the budget. So you can see the effective rates, and these are combining things like corporation tax, if it's applicable, things like dividends, or national insurance, if it's applicable on things like salary, and coming out with an effective rate that if, say, the company had £100,000 of profits, at what rate would different people pay if they're a basic high rate taxpayer, etc. What you can see here is that actually when we get into the higher additional rates, dividends are now actually more expensive than salary, but not at basic rates. That position does narrow a bit because of the NI increase, and so you can see there's actually very little in it, other than at basic rates. But the interesting one for me is the fact that self-employed, or those people that operate through partnerships, are now paying much lower marginal rates on their profits than people who take money out, have a company and take money out. We actually did I did a presentation after last year's budget, which is available on our YouTube channel for those that like that. And we've concluded that even though dividends are higher when you get into the higher rates, it's still best in most circumstances for owner managers to take that minimum 12,570 salary and the rest as dividends. And the reason for that is the fact that you get that differential in the basic rate band. It takes quite a long time for salary to then peter that out. But as I say, will people look at partnership structures in future? Possibly, but that comes with the cost of the fact that you don't have any choice on when you pay your tax. It just, as it accrues, that's when you're taxed on it. But potentially look at alternatives. So you can see on the previous slide, if you're someone that's, say, got property outside a company, or you've made a loan to your company, you could charge rent or interest, and that will attract a much better rate of tax. Just a quick word on money boxing. What do I mean by that? That's where people have a limited company, they're earning their profits, but they leave the cash in the company because they think they're going to have some form of exit event, or they're going to wind the company up at the end of its life and take their money out by way of capital gains tax, which is, on the face of it, should be cheaper. You just got to bear in mind that you'll have paid now 25% corporation tax, most likely, on those profits. And then when you're taking the money out, you're paying 18%, let's say if you're getting BADR, but more likely 24%. That gives you effective rates of between 38.5% and 43%, not entirely enticing. And I think it's things like this which are leading people to look at their company structures and think, well, should I be doing something different? And that leads us on quite nicely to the main bit I want to talk about, which is the changes to capital gains tax and what that might mean for people and their company structures. So I think the things that, these are kind of my thought processes when I'm looking at clients' structures. And the thing now when we're talking to clients is very much BADR, yeah, okay, it's there, but it was once a 10 million allowance, and at one point we had an 18% capital gains tax rate. So at its peak it was worth 1.8 million to a client. So we were very much concentrating on making sure that they ticked all the entrepreneurs relief BADR boxes. But as you can see, from April 26 next year, it's only worth a 6% saving, 60 grand. And without wanting to be flippant, for some clients, that's not really worth getting out of bed for. So what do I think are the alternatives that people are going to look at? Well, we're going to talk a little bit about SEIS and EIS, because I think sometimes those are overlooked when people are setting up businesses. There are potential for business owners to qualify for those reliefs, even though it's their own, in their heads, their own company. I'm also going to talk about something called the substantial shareholdings exemption, and for that read personal holding companies. I'll explain that when we get to it. It's, as kind of our experience shows, we probably do have to talk about the more radical options like moving abroad. We've had a lot of inquiries from people who, go back sort of 5 or 6 years, would never have thought of going and living somewhere else. But I think the experience of COVID and the fact that people realise, you can run your business from anywhere, people are a bit more open to it, and with the tax changes, that might just be providing the impetus for them to push ahead. I'm going to touch very briefly, if there's time, on employee ownership trusts. The key benefit there is that there's capital gains tax exemption if you sell to an EOT. And again, 0% versus 24%, I think it's probably going to become more attractive to people. So I'm going to look in sort of 3 stages. So first I'm going to start with people when they're setting up a company fresh. And then I'm going to look at what people might do when they've got an existing company. And then I'm going to take that through to what happens when they come to sell. And I thought the best way of doing this was with an example. So a fictional example, and you can probably tell my age from this, is that we've got Chipmunks Limited, which is a company that's being set up by 3 individuals, Alvin, Simon and Theodore, and it's going to trade in music production. The shareholders are unrelated. Alvin is single. Simon is married with 2 children. I don't know about Theodore, obviously doesn't kiss and tell, but it's not relevant. The company's going to need 500 grand to start off, and they think that within 5 years it's going to be worth 5 million. What these tables show is that if they just set up the company like this, owning their shares directly and not using any reliefs, what their tax position would be if they sold in 5 years for 5 million. All this is doing is apportioning the proceeds and the costs. They get BADR at 10% on the first million, and then if they've gone over that, they pay 20%. So that was the position before the budget. And what I've done at the bottom is just to show what the multiple return they've had on their original investment is. So it's higher for Theodore because he's not getting into the higher rate of tax. And then on the next slide, what I've done is to show the position after the budget, and I've taken the worst case scenario next April when we've got that 18% rate of BADR. So what you can see here is that BADR, it's gone up from 100 grand to 180 grand where they're using the full £1 million allowance, and then above that they're paying capital gains tax at 24%. I've then compared the multiples, and then all I've done underneath is just to show how that multiple's reduced in percentage terms. And that was purely to illustrate the fact that for people who are very reliant on BADR, they're going to be the ones that are more affected than people who were paying 20%, it's gone to 24%, which is intuitive. So what would we do with this client to improve the position? Well, as I've said, BADR is less important, I think, these days. It's only worth a maximum of 60k per person. But this is where I think people should be looking at SEIS and EIS. These are two government-approved schemes where if they qualify and they meet all the conditions, after 3 years, when they come to sell the shares, it's completely tax-free. But there are conditions, so it won't apply to everyone. And the main one is the fact that the capital gains tax exemption is only available to a shareholder owning up to a 30% interest, and that includes any people that they're closely related to. So you can see in this example, it's not going to be relevant to Alvin and Simon, but it would be relevant to Theodore. It's also not available to every business, so there's various excluded trades, things like accountancy, unfortunately, legal services, they won't qualify. In Theodore's case, he does want to be a director of this company because of the size of shareholding that he's got. The important point to know there is you've just got to get the timing right. He can't be a director before he subscribes for the shares. He can become a director after, and it can be paid, but it has to be at market rates, and it has to be done in that order. There also can't be any connection to the trade. So if Theodore's potentially, had this business and he's incorporated it, he couldn't qualify. And then there's also an independence test. So the company that you're investing in can't be under the control of another company. And that was purposely why I didn't put any of the other shareholders above 50%. There's lots more conditions attached to SEIS and EIS, but again, we've got a YouTube video. Adam Sedgwick did a really good presentation, one of our breakfast seminars in June 23, so that's online if you want to go and have a look at it. So that's EIS, SEIS. The other area, and this is where I'm going to look at the other two shareholders, is something called substantial shareholdings exemption. And as I say, read for that personal holding company. So what Alvin and Simon do, because this is a fresh company, is that they don't subscribe for their shares directly, but they each set up a personal holding company, and that company is going to hold the shares. What's the advantage of this? Well, after 12 months, they should qualify for something called the Substantial Shareholdings Exemption, or SSE. What that provides is that when the company is sold, there would be, clearly the company's making a disposal on which you would normally pay corporation tax. They qualify for SSE, it doesn't pay corporation tax. And effectively what that's doing is providing a deferral of the capital gains tax until such point that they want to take the money out of the company. So if there's someone that's already quite wealthy, who may want to reinvest or go into a different trade, this is a really good vehicle from which to roll over their money. We're seeing a lot of it with families where they're already wealthy. They sell the business and then they keep the company and operate it as like an investment vehicle. There's also the ability through the holding companies to bring in other family members, which is very useful clearly because then you can spread your dividends around. So bringing in spouse, bringing in children, albeit I would say adult children, because you have to be very careful with diverting income. You basically will get, it won't work if you try and divert income to minor children. When I touch on moving abroad, this structure may also offer some flexibility. And what's the downside? Well, obviously there's an increased cost for the client in having to operate a limited company. But if they're already familiar with it, and particularly if it's just a holding company that's going to receive dividends and pay them out, there actually might not be that much admin involved with it. The main tax disadvantage is the potential loss of business property relief, and that's because when they held the shares directly, this is a trading company, they would have got business property relief. When you put the shares into a holding company, it's the shares in the holding company that you're needing to qualify with. And a holding company will only qualify if it is a holding company, i.e. it's got more than 50% of the subsidiary. So clearly in these situations, you're only ever going to get that once, and in my example, none of them actually qualify. So just delving into the detail of SSE, yes, it's got some conditions attached to it. What these broadly are is, firstly, the company that you're investing in must be a trading company. I put in brackets a sort of 20% rule of thumb test. If that company's got other stuff in it, like, I don't know, they've gone and bought buy-to-let properties or something, you just have to be careful that those activities don't outweigh or don't start to taint the trading activities. And the rule of thumb is 20%, but HMRC used to sort of use that, and they're gearing away from it. So you really have to look at the company and say, is this properly a trading company? There's a 10% minimum shareholding requirement, and that 10% is by reference to three individual factors. 10% of the ordinary share capital, 10% of the profits available for distribution, i.e. the dividends, and 10% of assets on a winding up. Those conditions have to be met for a full 12 months. It doesn't have to be the 12 months up to the disposal, so it's not like BADR, but it has to be a 12-month holding period, continuous 12-month period, that ends no more than 5 years before the date of disposal. That's quite useful in that if you set up your company and say you have 10% exactly, and then there's an investment round and you dilute, provided you achieve that 12-month period, you do get a run-off. So it's quite useful with clients. I can think of one client I've got where his company's listed and he has more than 10%, but he's now gone below and he's going to sell them periodically. Because of these conditions, I think there's one thing that you have to be really careful with, and that's alphabet shares. So what are alphabet shares? These are typically where you have more than one shareholder in a company, and you decide we're not just going to have one class of share, each shareholder is going to have their own class, and typically it's A, B, C, etc. Usually the articles will give that person a fixed capital right, but what they will do is they'll usually say, when it comes to dividends, if the board wants to pay the dividends out at a different rate, they have the discretion to do so. Because you might have, particularly in professional practices, say, someone's worked really hard this year, they should get a bigger dividend, or she's had a pension contribution, so she should get less. Now, when we've got setting up companies for BADR, alphabet shares don't cause us a problem usually, because the rules say you've got to have 5% of the ordinary share capital, you've got to have either 5% of profits available for distribution or assets that are winding up. So as long as you've got the assets on a winding up condition, you should get BADR. Problem with SSE rules is that they aren't an or test, it's all three. And therefore, if you've put in these discretionary rights, there's a potential risk that HMRC could say, well, the board could choose never to pay a dividend on one of the classes of shares, and so you haven't got a guaranteed right to 10% of profits. What do I think should be done about this? Well, if you still want discretion, I think what you need to put in your articles is something which says, if any dividends paid, the classes that are relying upon SSE are always entitled to at least 10%. If you do that, there can be no argument in my view. You may want to take it a little bit further if people go, well, actually, I don't want my 10% this year. You could use dividend waivers, but I don't particularly like those. They're messy. You've got to check that you've got the necessary reserves, etc. You could alternatively put in some form of veto right that says, we will pay. If the board decides it wants to pay out dividends at a different rate, I can stop that so that I can always get my 10%. But like I said, I think the best thing to do is just to give them a guaranteed 10% right at all times. Just going to touch briefly on BADR. So if you remember how this was set up, we had Alvin with his company. He's quite happy. It's only him as a shareholder. But Simon has a wife and children. I'm not saying that makes him unhappy, but His wife has put the pressure on and said, I want 25%, and he's gone, yeah, okay. And also he's got these greedy children that also want shares. So he's given them 12% each. They're all going to be directors of the company. The question is, do they get BADR? Because he thinks they do, because they've all got more than 5% of the shares. And the problem here is that a number of years ago, HMRC changed the rules on companies that mean it's not just a case of, well, firstly, what you've got to have is either an interest in a trading company or a holding company of a trading group. And as I explained earlier, this is not a holding company because it's got less than 50%. However, because of the way that the group's been set up, his company can effectively borrow the trading activities of Chipmunks through something called joint venture rules. What that means is that because he's got more than 10%, the trading activities can be apportioned at the relevant percentage into his holding company. So if his holding company doesn't do anything else, it's going to be treated as a trading company for these purposes. But you still have to have an effective 5% interest. And what that means is that when you multiply through the percentages, you still have to get yourself above the 5% threshold. So Simon's all right. His wife, we're multiplying 25% by 35. That gets us to 8.75%. She's all right. But the children, when you multiply 12 by 35, it's 4.2. They're below the threshold and they won't qualify. You'll have to trust me on this, but I calculated it by reference to the proceeds or the gain that they were expecting to make, and in this case, they've wasted nearly 400 grand of their BADR. Solution in this case, if they'd have just given the wife and the two children 15% each, that would have taken to 5.25 and they'd have been all right. So that's my thought process on existing on new companies. Now I'm going to look at what we might do with existing structures. And here it's a bit harder, clearly, and I'm going to do another example using a company called Rainbow. And the shareholders in this case are Zippy, George and Bungle. And it trades in the sale of maracas. The shareholders are unrelated, and the business was set up 15 years ago. And it's worth £10 million. Now what I haven't included on this diagram, but you just have to bear in mind is in the background, is that there's also a management team that have been incentivised with some EMI options, and that's going to give them 10% of the company when those are exercised. So clearly with an existing company, EIS, SEIS, it's not really applicable because it's already worth a lot, and also in this case it was set up too long ago. So the thought process here is, right, we should be looking at what options we've got, let's say, to spread ownership between other family members, because we've got quite a valuable company now, and that's with a view to obtaining more BADR allowances. But then, for the more substantial shareholders, could they benefit from a personal holding company? So the issues here are things like capital gains tax, inheritance tax, of course, with BPR, but also stamp duty, because we're dealing with shares in an existing company that's got value. So starting with spreading ownership across other family members, you can give shares to a spouse. If you do that, no capital gains tax, no stamp duty. What that does, it gives you the ability to access an additional £1 million allowance once those shares have been held for 2 years. Of course, that spouse must be an officer or employee of the company. If there's any doubt over whether someone's actually doing proper work in a company, make them the company secretary. It's a role that doesn't have any sort of statutory duties, and bizarrely you can have as many company secretaries as you want. It's such an easy way into BADR. Director obviously has some statutory duties. That's maybe why a spouse wouldn't want to be appointed as a director. But as I say, it's only really offering another 60k. So you could look at gifting shares even wider. So let's say you've got other family members like children, that gives you the ability to access their BADR allowances, again after 2 years, but again they must be working in the company or have multiple company secretaries. There's no automatic exemption for giving shares to people that aren't your spouse. So what you have to do here is make a holdover election. That's only available to trading companies, and it's got other conditions attached to it. But what that basically does is it says the parent giving the shares away, they're making a disposal, but they don't pay any capital gains tax on it, and the person getting the shares just inherits their base costs, and they will pay the capital gains tax when they come to sell. Again, if it's a gift, there'll be no stamp duty. I've put here ERS implications, that's employment-related securities. You just have to be slightly careful if people work in the business. Employment-related securities rules, if you gave shares to an employee and they had value, they would pay tax on it in most situations. So if you've got a child working in the company, those rules could potentially bite. However, there is an exception for gifts or transfers that are made not because of their employment, but because of some personal or domestic relationship. I would just take care there that if you're doing this at the same time that you're giving shares to all your employees, and you've got a person that's working in the company, I think HMRC could say, is that really, you're doing it at a time when you're making awards to other people. Likewise, if it's, because a sale's going to happen in the next 6 months, you have to be very careful. I will say, it doesn't have to be children, it could be a personal friend even, and we've actually been successful in getting HMRC to sort of sanction gifts to people that are really close friends, and confirm that the exemption will apply. So that's straightforward. Personal holding company, we touched on that in the earlier part of the talk. And what I explained the benefits of that, the fact you can potentially defer tax and you can also receive your dividends into your holding company tax-free. Where you've got an existing company, it's not straightforward because you've already got shares and they've already got value. To get them into a holding company, you're going to have the only way really to do it without a tax problem is to do a share-for-share exchange. And that share-for-share exchange must meet what they call reconstruction relief conditions. If they don't, then it's a taxable disposal and you're probably not going to do it. Under reconstruction relief, what that does is it says the disposal of the shares to the holding company and the issue of shares in return, it's treated as a completely tax neutral transaction. You can get HMRC clearance for it, which I'll come on to in a second. But the objective conditions that are in the legislation are that as a result of the exchange, Holdco does or will own more than 25% of the ordinary share capital. I've put more in bold there because I think people think 25%, oh yeah, that's all I need. It's more than 25%. I've seen someone's clearance, not mine, where HMRC went back and oh yeah, it's good, agree with all the rationale, but you do know you've only got 25%, which I thought was quite nice of them. Alternatively, you can qualify if that holding company is going to have the greater part of the voting power, or a lesser used one if it's been done as part of a general offer made to shareholders that would result in the holding company having control. Don't see that really in these situations because it's unlikely that someone's personal holding company is going to make an offer to all the other shareholders. So those are the objective conditions, but there's also an anti-avoidance condition. So this transaction must be for bona fide commercial reasons, and it can't have a main or one of the main purposes being the avoidance of tax. Now, HMRC have always been sceptical about personal holding companies, which you can understand because, if someone's just wanting as a route to get strip dividends out of the company and house them in their holding company, they might feel that is avoiding income tax that would otherwise be paid if those dividends were paid out. My counter argument to that would be, well, no, they'll just leave the dividends in the trading company. But I suppose also they may be looking at it, with an eye to, is this person, on the eve of selling the company and trying to benefit in some way. So it's important, I would say essential, that you get HMRC clearance. It's not guaranteed, and certainly at different times HMRC have been sceptical of holding companies. But we've been successful on at least 3 or 4 in the last 12 months. And I think the one key point that seems to come up when HMRC asks questions is, okay, what's the benefit? And this is right for any clearance application that you do. What is the benefit to the company? Or another way, can you show that the company is not suffering by what you're doing? And a key thing that they seem to like is that if you take your dividends out of the holding company, but you are prepared to lend that money back to the trading company if it needs it. So that has, in quite a few cases, been what's got us over the line.
Out of trading company, not out of holding company.
Sorry?
You said out of the holding company, you mean out of trading company and then them back in?
Yes, sorry. If you're paying a dividend into your holding company, that you have an agreement with the trading company that the holding company will lend the money back if it needs it. There is a stamp duty cost though with doing this. You won't qualify for any reliefs because you're not creating a mirror image of the original company and the holding company. So there's a 0.5% cost on whatever the market value of the shares is. But in cases where it's not a majority interest, or it's less than 100%, then there might be discounts that you can apply. So going back to the example, Zippy and George can put a holding company in place, but Bungle can't because he's got less than 25%. If a holding company is put in place for those 2 individuals, well, Zippy, his will actually be a holding company under the tax definition, so he should still get BPR on those shares, but as I've explained, George won't. But these people are quite young and they're quite comfortable with the risk. What does Bungle do? Well, he can't do the holding company, but he does gift shares to his wife, and she becomes, on our advice, the company secretary. I mentioned a few slides ago that there was an EMI scheme, and this is why deliberately I put Zippy's shareholding at 55%. The point to be aware of is if you've got an EMI scheme in your company and one of the shareholders puts a holding company in place that is more than 50%, that will breach the independence condition. So that was something I mentioned under EIS relief, but there's almost identical rules for EMI purposes. So if that holding company is put in place for Zippy, the management shareholders' EMI options will fail. What I mean by that is that if they just leave them as options, they'll just become ordinary options. So there would be the ability, if they're prepared to do so, let's hope that there might be something in the EMI scheme rules that allow this to happen, that the option holders can exercise early. So it's just a point of caution if you're advising people where there's an existing EMI schemes to take care. So this is what actually happens. Indeed, the EMI option holders do exercise, and so what I'm showing here is the position after their 10% shareholding has been issued. As I said, Bungle decides he's going to split his shares with his wife. At this point, the company, as I said, was worth, his shares are worth 1.5 million. So what that's doing is it's potentially accessing her BADR allowance as well as his. Zippy and George have transferred their shares to holding companies, and we got clearance for it, and they've paid 0.5% stamp duty on that transaction. So, having looked at setup of new companies and existing companies, I'm going to move on to look at what happens when we come to sell them. So we're going to go back to example 1, which is the chipmunks. And indeed, this company's actually done really well, and it's someone's made an offer in year 4 for £5 million. Theodore did subscribe under EIS, and therefore he pays no capital gains tax. Alvin created his holding company. He gets the benefit of SSC because the shares have been held for more than 12 months. And what he's decided to do is going to leave the money, he's going to benefit from that tax deferral. He's going to set up, well, he's got no family actually, but I've used family investment company as a sort of collective term. because that's usually what people are doing if they decide to do that. He's achieved tax-free deferral, and it's deferral, so he's going to pay capital gains tax when he ultimately winds up this company, but it's the benefit that he's got of paying no tax on the proceeds and reinvesting and growing his fund a bit more. Okay, he's got the potential loss of BADR, but as I've said, it's only 60 grand in the context of a multi-million-pound company. Simon, however, decides he needs the money, or his wife does, and decides to wind up the company. The important point just to say here is, once you've got through that 12-month window with SSE, you're no worse off, because if he winds up the company, and in this case he structured it so that he's qualified for BADR, he's just going to get that when he liquidates the company. So, you know, when we're saying pros and cons, I don't see massive downsides with personal holding companies. One potential downside, though, is here. This is the second example with Rainbow. As you recall, we've done the EMI scheme, we've done the holding companies, and after we did all of that, after 6 months, someone came along and made an offer for £10 million. And clearly, the issue here is, well, there's two issues. One is that Bungle's wife hasn't held her shares for the requisite 2-year period for BADR. And secondly, the holding companies haven't held their shares for the 12-month period that's required for SSE. Well, Bungle's wife can simply transfer her shares back to Bungle, and because he's met the 2-year time limit, he's had 5%, he can get his full £1 million, and it's just the downside is they're not accessing hers, but they weren't beforehand anyway, so no downside there. What about the companies though? This is where you need to understand how that share-for-share exchange operates. So for corporation tax purposes, when you transfer shares to a company in exchange for being issued new shares, yes, that bit's tax neutral from your own point of view, but the company is acquiring those shares for tax purposes at market value. And so they'll have been uplifted. Now you might think, okay, well that's great, because I'm going to sell them, and therefore I'm going to pay no tax because I'm going to sell them at market value. And the issue is that market value on a transaction like that, that's just individual shareholdings, you need to look at what that individual shareholding, if it was sold in isolation, would be worth. And that's where discounts would come in. So with Zippy, it's not 100%, but it is still a majority interest. You're probably looking at a discount of 5 to 10%, let's say. George's shares, however, are a minority interest, and so the discount is much bigger. So for corporation tax purposes, let's take George as an example, his holding company will have acquired those shares at probably 70% of what they're ultimately sold for. So what that means is you've got this potential corporation tax exposure on that discount for the 12-month period before you're into SSE and you get the exemption. But if you're in that situation, so 6 months after this has been done, I don't know how long it would take solicitors to do all their due diligence, probably 3 or 4 months. You could be getting quite close to the 12-month period. You would hope that a friendly purchaser would be willing to let the sale drag on a little bit longer to get you over the 12-month threshold. If not, you could potentially lock it in with some sort of cross option whereby they've got the right to buy and you've got the right to sell once you get to 12 months, something like that. However, sadly that deal didn't work out, but another one did come along 2 years later and they managed to get 15 million. So that's good from Bungle's point of view, that he's accessed his wife's BADR. George hasn't got that problem with the discount. And those people are happy, but Zippy, well in this case, Zippy wants his money. He's itching to get his hands on the proceeds, which are just shy of 7.5 million. Now again, you're going to have to trust me on this. I've calculated the capital gains tax at 1.72 million. That's payable assuming he gets the money into his holding company and immediately appoints a liquidator and gets the money out. But Zippy's 24%, you know, previously he was thinking it was 10% on 10 million. Doesn't like the sound of that. And that's where moving abroad comes in. This is radical, clearly, but you know, we're getting so many inquiries about this. I think it is a realistic option for a lot of clients now. So what if Zippy is prepared to move abroad? Well, clearly the main question is, where's he going to go? You're going to go to somewhere, ideally, with either lower capital gains tax or lower income tax on foreign dividends. And there are various places. I've listed them here, but I've just add a big health warning because the rules are changing all the time. And you know, some of these regimes, yes, you can get your dividends out, but you're paying a charge to access that regime. But you know, certainly places like Dubai are becoming very popular. Portugal used to be popular, but unfortunately they've changed their regime very recently. So once you've chosen a place to go to, the question then is about timing. And the good thing with the holding company is the timing is less important, because clearly if you're in the process of selling the company and you own the shares directly, you need to make sure when you sell you're non-resident. With a holding company, it's the holding company making the disposal, and as long as it's got SSE, the money's there in the holding company, and you could move abroad with that company and make the timing of the extraction at a point when you're absolutely certain you've broken UK residence. So that's why I've said timing of withdrawal is important. Should say that the UK has a temporary non-residence rule, so you just have to warn clients if they do this, is a case of you've got to break UK residence for a full, our advice is a full 6 tax years. If you come back or do something to regain UK residence in that time, the rules will reassess you as if you'd never left. I've mentioned inheritance tax just from the point of view that you might be breaking residence for capital gains tax purposes, but potentially not for inheritance tax. There's roughly now, under these new rules, a 10-year tail before you get out of inheritance tax. I just want to mention a couple of common pitfalls with moving abroad. When the government introduced the statutory residence test, I think that was quite popular amongst advisors because we now have a really bright line test as to whether you're resident or not resident, because all of the tests are objective. But because of that, and because of the number of different ways in which you can, number of different tests that apply, there are some pitfalls, and I'm just going to cover a couple of them. And these have been covered, I think, in our tax bites as well. Andrew Marr's not here today, but this is the one that he gets really excited about. So this is something called the second automatic UK test. And it applies, so this will make you UK resident if you have a home in the UK for part of the year, if you spend 30 days in the UK at that home, and this is the important one, whilst you have that home, there's at least one consecutive 91-day period, at least 30 of which fall in the tax year, during which you don't have a home overseas, or you have a home overseas but you spent less than 30 days in it in the relevant tax year. Probably best if I give you an example. So, Zippy, having sold the business and the money's in this company, decides he's going to move to Dubai, which he does on 6th of April 25. But he hasn't found a property yet, and so for the first month he's going to stay in a hotel whilst he finds a place to buy. He moves into the property the next day, 7th, so after a month. And then for the remainder of the year, he's taken advice and he knows he's got a 90-day time limit because of his ties to the UK, but he only returns to the UK for 5 weeks. But when he does so, he goes and lives in his property that he's retained. Big mistake here. He fails this test because A, he's got the UK home in the relevant tax year, B, he's spent more than 30 days there when he's come back, and C, and this is the bit that people fall over on, there is a continuous 91-day period of which 30 were in the relevant tax year when he has no overseas home. It's that month when he was in the hotel, he had his UK home, but he didn't have somewhere overseas. So if Zippy had then drained his company of dividends, unfortunately he's got liable to UK income tax. The second pitfall is what they call the third automatic UK test. So again, if you meet these, you're going to be automatically UK resident. And this one is to do with your working pattern. So it applies if an individual works full-time in the UK for any period of 365 days, again, part of which falls within the tax year, where there's been no significant break. And a significant break for these purposes is broadly a period of 31 days when you do not work for more than 3 hours in the UK. By the way, that doesn't include if you take annual leave or you're sick. It's got to be proper 31 days when you would have been working and you don't. B, more than 75% of the total days in that period on which they work more than 3 hours are days when the work is in the UK. And C, at least one day in the relevant tax year is a day on which the individual works more than 3 hours. Again, probably best with an example. So, Zippy has been working full-time up until the end of March 25. He goes to Dubai the next day, and again, he knows what his maximum days are and he's going to restrict them. But one of those days when he comes back to the UK is on the 25th of April, and he comes back for a board meeting that takes more than 5 hours. What's the issue? Well, the problem here, the clincher, is that he hasn't achieved a significant break from his UK duties, because from the 31st of March, when he's sort of in his head given up work in the UK, he hasn't achieved a clear 31-day break, because he came back and did work in the UK within those on the 25th of April. And that day counts as part of a rolling 365-day period that falls in the tax year. That one day is the end of that period, and it's in the tax year that he wants to be non-resident. So he's going to be automatically UK resident again as a result of just one day. That emphasises again the importance of anyone, if they've been working full-time before they go abroad, making sure that they achieve that significant break. I think, yes, we do have time. Just wanted to touch very briefly then on employee ownership trusts. So very much seem to be flavour of the month. The main advantage of selling to an EOT, or the attraction of them, is the fact that the selling shareholders will not pay capital gains tax. And so they're going to pay 24%. That's quite a considerable saving. They are also good in situations where potentially you've got business that might be a little bit niche, you know, that is not going to be just put on the market and sold instantly. So it is good where it gives you the ability to create a disposal where one might not otherwise be achievable. You can also, if you're a selling shareholder, still have some influence in running the business. But I've put that in inverted commas because revenue has tightened up on the rules at the last budget. So, for example, I think now you have to have a majority of trustees of this trust that are properly independent people. And, you know, it's fair to say for some people there's wide altruistic benefits. You know, this is all about sort of promoting employees, running, you know, companies, John Lewis type structure. For some clients, that's like what they've been working their whole life towards. But there are points to consider. So firstly, you've got to be selling a majority interest. And of course that does mean you've got a loss of overall control. So it might not be suitable in every circumstance. I also don't think it's suitable necessarily for every type of business. You know, if you're the type of business that has been, you know, sort of honing a management team and building them up, and they're capable of taking over the business, you know, you're almost sort of pulling the rug from under them by selling to all the employees, where potentially actually when they come to sell, they might not even get any tax benefit out of it. So the benefits are skewed more towards the selling shareholders. I have said as well, HMRC clearance is recommended purely because you're sort of doing an internal transaction, so you'll want to definitely get what they call transactions and securities clearance for this type of thing. And then this final slide just shows, let's say this was a really niche company, well, it sold maracas, which is pretty niche, and they can't find a seller and they go down the EOT route. This was just to illustrate the fact that it wouldn't need to be all the shareholders, but it would need to be more than 50%. So quite neatly, I've got George and the others excluding Zippy at 50.5%. Zippy could be included in selling to the EOT if you wanted to, but the point to note on Zippy and George is that they don't benefit from the EOT exemption. Their companies will still get SSE, but it's not that they can then take their money out of the company, so tax-free. So if you're setting up a business and you think there's a strong chance an EOT is the end point, the holding company may not be the route for you. I've probably got like 2 or 3 minutes if anyone wants to ask any questions. Yes?
On the EOT there, it's just that the seller doesn't pay CGT. Is the CGT borne by the trust? Or is it just the trust not have to pay the people who are trustees?
Yeah, the way they typically operate is that it's either the trust will borrow to buy the shareholder out, or it could be funded out of profits. If later the company is sold on, then the trust will have capital gains tax to pay. That's why I don't see them having massive advantages to the people in the trust, because they're paying capital gains tax, and then there's also tax on getting the money out of the trust as well.
So that liability that would have been with the seller is essentially with the buyer.
No, because it will have acquired the shares at market value. So, but any future growth, yes, they're getting taxed on.
Could you set up AMI schemes alongside?
Yes, you can, and the management team could sort of do an MBO on the other 49% if they wanted. Yeah.
If you go and live offshore, and you said you can't work in a company for more than 3 hours a day, does that include travelling?
Well, the 3 hours. Are you really working when you're travelling? I think commuting probably.
I've read that
You can fly to the UK, that's not work. But if you're flying to the if you're flying to the UK to work, that flight time, even if you're working on the plane.
No, what I'm talking about is when you're back in England and you go to the office, does the time it takes to get to the office, is that included in the 3 hours?
I don't think it is. I think it's if you're then going, say, from the office to a business meeting. If you're then travelling to Scotland, say,
So
from your London office, that's an issue.
Okay, if there's no more questions, what I'll do is if anyone wants to see me during the break, I'm happy to take one-to-one questions. But we've got a coffee break now, so if we can be back for 11:15.
Okay, welcome back everybody. I think we're mostly all back now, so we'll carry on. That's okay. So in this section, I'm going to talk a little bit about BPR and succession planning for the family business in light of the new changes that were introduced sort of post budget. We're also going to look a little bit about how those changes are going to affect trusts, and then going forward what the kind of post-April 26 landscape is likely to look like a bit for estate planning. So Tom's obviously touched on these BPR changes in the first half, but just to recap, it was announced in the October budget the introduction of this £1 million limit for BPR qualifying assets that will attract 100% relief. That's relevant for both individuals and trustees, and then any excess value over 1 million is only going to attract relief at a reduced rate of 50%. So what we have now is effectively a 20% IHT rate on death on qualifying assets over £1 million, and potentially for trusts as well, we've got an effective 3% tax rate at 10-year anniversary charges and things. So the changes were announced in the budget with not much in the way of additional detail, so that kind of led to a couple of months of speculation from the press and advisors, and a lot of kind of concern for clients about how that's actually going to affect them. And it wasn't really until February when we had a little bit more meat put on the bones when the Treasury published their consultation document. So this document sort of confirmed that the £1 million allowance is due to replenish every 7 years, similar to how the nil rate band works. But one key difference is that it actually confirmed that this allowance is not going to be transferable between spouses, which is quite important when we come on to planning, because there's obviously going to be a greater emphasis on ensuring that spouses, particularly in family situations, are utilising their £1 million allowances. Also have effect for trusts, so there's expected to be a single £1 million allowance for all trusts settled by the same settlor after budget day. This allocation will apply for the lifetime of the trusts, and we believe that all trusts holding qualifying assets on budget day will qualify for their own individual £1 million allowances, so there'll be no kind of sharing of allowances with later trusts. Now there are still some uncertainties from the consultation document. It doesn't give us perfect clarity. We don't have any draft legislation yet, so we're not clear whether or not, say, trusts settled by the same settlor after 7 years post-budget day are going to be aggregated and share a £1 million allowance, or whether that kind of replenishment of the £1 million allowance is going to mean that a later trust will also have a full £1 million allowance available. And there was also mention of anti-fragmentation rules as well, so kind of an extension of those related property rules which treat currently assets held by spouses as being aggregated. So there's still quite a lot of uncertainty, and that does make it a little bit difficult sometimes in advising clients on the best course of action. But obviously we've only got about 10 months now until these changes come into force, so it's not really an option to sort of sit around and wait for clarity with draft legislation. So we're sort of trying to preempt the rules a little bit, not so much guess, but have a kind of a rough idea of what the rules are likely to look like, and then also we don't want to put clients in any worse position than they otherwise would be if the rules don't quite turn out as we expect them to. So I think I'm going to look at a sort of a client case study of some recent planning that we've been doing. So just to kind of set the background, what are the sort of things that we're thinking about in this situation. At the outset, it's important to know what the client's intentions are likely to be. Is this a family business that they just want to pass down the generations for the younger members of the family to carry on, or is there any likelihood of a sale at some point in the future? That's quite important now because obviously we've got that effective 20% IHT rate on death potentially, which has to be compared against the benefit of the capital gains tax uplift now with CGT at 24%. So I'm going to look at succession. Laura in the second half is going to look at sort of preparing or IHT planning in the context of a business sale. So as we're looking at utilising £1 million allowances across family members and trusts where possible. We've got this window of opportunity before April 26 where we can transfer unlimited value into trusts without an immediate IHT charge. We'll look at that a little bit more later, but briefly, post-April, we're going to be restricted to 1.65 million that we can settle into trust without a lifetime IHT charge. Can we fragment ownership to benefit from more valuation discounts? Can other members of the family have minority interest potentially, lose a lot of that value through discounts? So we're sort of preempting how these anti-fragmentation rules will look, and then also, as always, working out what the optimal order for gifts is. So here's our case study company, Sugar Limited. So it was set up by Alan and his wife Margaret many years ago. Company worth about 12.5 million. So the children Tim and Karen work in the business. The intention is that they will take over the company in future and continue to run it, pass it down the generations. So Alan and Margaret together are still majority shareholders. They hold sort of 80% of the shares. They gave a small shareholding to Tim and Karen many years ago, so more than 7 years ago, so they survived that gift. And then there was also a couple of trusts settled in 2011 to get dividends to the grandchildren, for example. So Alan and Margaret have not really been too concerned about doing any further planning at this point, because they've always expected that their shares will qualify for full BPR on death. The family's been relatively comfortable with how things are. Obviously, that position is going to change from April 26, and this is what it's going to look like. So, just to kind of give you a quick summary, if we look at Alan and Margaret, their sort of 80% interest, after taking into account a very small minority discount of sort of 5%, because collectively they have over 75% control, you're looking at a discounted value of potentially £9.5 million there. Obviously they'll each qualify for their £1 million BPR allowance, and then potentially 50% BPR in the excess, but that still leaves £3.75 million of taxable value in their estate. So from 6th of April, they've potentially got an inheritance tax exposure of 1.5 million there, that obviously the estate will have to find, or Tim and Karen will have to find somehow to kind of keep that business in the family if they wanted to. So how do we approach this? So looking at the order of the gifts that we decided to recommend, it's first that we'd look at gifting shares onto new trusts. So as I say, we can settle unrestricted value onto new trusts before April of next year. In this instance, we decided to settle 9.9%, just on the basis that it's just below a key valuation discount of sort of 10%, so that those shares should benefit from a large discount in the trusts. We're not quite sure how the allocation of the £1 million business relief allowance to trusts will work. Will it be based on the diminution in value calculation? And if it is, does that mean we should be trying to ensure that there's at least £1 million diminution in value in the gift? Or will it be allocated in some other way, such as based on the CGT value of the shares? Come to look at that a little bit more later. So once we've settled those new trusts, so Alan and Margaret settling a trust each, we moved on to consider whether or not there are any old BPR trusts that can be topped up. So if those old trusts each have a £1 million allowance now going forward, they could potentially be quite valuable for families that have those. So here, obviously they held 5% each beforehand, so we've recommended topping those trusts up with a further 4.9% to bring those old trusts up to 9.9% as well. So there's then sort of 40% across the trusts. And then as a third step, we look at making some potentially exempt transfers. So this is just gifts to Tim and Karen from Alan and Margaret, just to kind of bring their shareholding up and to bring Alan and Margaret's combined shareholding down to around 25%, because we still want to leave some shares with Alan and Margaret, so that they can use their £1 million allowances on death as well. And then as a final step, we want to equalise that shareholding between the surviving spouses. I've got a slide later about what that position looks like afterwards. So I'm not going to go through every gifting step every step in terms of the calculations, but I just wanted to pull out this one example of how the kind of diminution in value calculation works on each gift. So we're looking at the first gift made, a 9.9% shareholding made by Margaret onto a new trust. So before the gift, Margaret had 20% shareholding, which after factoring in a small 5% discount is worth about 2.375 million. Obviously by making that gift, she reduces her interest from 20 down to 10.1%, and that brings her and Alan's combined shareholding down from 80 to 70.1%. So you'll see that the gift that Margaret has made is proportionately larger than the percentage of the shares that she's given away, because she's had the effect of that large valuation discount jump in the position before and after. Now, because this gift brings Margaret and Alan's combined shareholding to less than 75%, which is a key valuation threshold, this gift also has a bit of an effect on Alan's estate. So, before Margaret made the gift, they held 80% of the shares together, and Alan's 7.5 million shares on a pro rata basis will attract a sort of 5% discount. Obviously now they're holding less than 75%, so potentially a larger discount up to 10% may apply. So without Alan actually making a gift, the value of his shares has reduced from sort of 7.125 million to 6.75 million. So there's an immediate loss to his estate there of £375,000 that he's not done anything to cause. It's just a quirk of how the diminution in value calculation works. So that loss of value is not subject to a 7-year survivorship period. So there's potentially an immediate saving available there on day one. Again, I'm not going to go through all the gifts in step, but this table just shows the diminution of value at each step and the order of the gifts that we propose to make. So again, at step 5, where Margaret gives away her remaining shares, that brings their combined shareholding underneath 50%, which again will provide a reduction in Alan's shares that he retains. So there's potentially about £1.5 million of value lost here, which results in a £300,000 inheritance tax saving. And that's literally just arisen naturally through the fact that Alan had a proportionately much higher shareholding than Margaret. So when Margaret's taking the discount hits at each stage, Alan's retained shares are also losing value at the same time. So this is the position after planning. So Alan and Margaret each holding 12.5% of shares, retaining 25%. Tim and Karen have been brought up to 17.7% each, and then we've got just under 10% in each of the trusts. So we've kind of fragmented the shareholding quite nicely, but if Alan's still kind of very heavily involved in running the business and wanting to retain control, and he's a trustee of all the trusts, he still has that control by virtue of his own personally held shares, and Margaret's, and through the trusts. So this just demonstrates the position for Alan and Margaret after 7 years. So assuming they survive the gifts and there's no clawback, I think Laura's going to explore the kind of clawback in more detail in her section. So they're attracting a much greater discount now on their retained shareholding, bringing the discounted value of their shares down to about 860,000. So you can see we are using up their BPR allowance once it gets replenished. There's a little bit of headroom for growth, but we've potentially avoided a £1.5 million charge on death. But going back, obviously, if they did pass away within a 7-year period, we have still achieved some immediate savings on day one. And then just for completeness, this kind of shows the position in all the trusts, with large discounts applying and a very low discounted value. So it should be quite a long time and a lot of growth in the value of the company before we get concerned about 10-year charges in those trusts. So this obviously assumes that the old 2011 trusts will get a full BPR allowance, and that they're not going to be aggregated with the 25 trusts for kind of valuation purposes. So how do we expect the new BPR rules to interact with trusts? So for pre-budget day trusts, it's almost business as usual up until the date of the first 10-year charge. So there's unlimited relief for exits from those pre-budget day trusts before the first 10-year charge, and that £1 million limit is only going to kick in on the occasion of the first 10-year charge. So if you're in a fortunate position where you maybe have a trust that's either just had a 10-year charge or is due to have one before April next year, you've potentially got 10 years to decide what to do with the assets in the trust before you're under the new rules. At the first 10-year anniversary, that £1 million limit will apply, with the excess only qualifying for relief at 50%, but there's also going to be an apportionment for that first 10-year charge period where the proportion of time relating to the assets held before April will qualify for 100% relief. So So that's some relief for those old trusts. It's worth noting that the relief that applies on that 10-year charge, any exits following that occasion will be based on the unrelieved rate rather than the rate factoring in that relief. Oh, sorry. Also, just to reiterate, we don't expect that these trusts will share any allowances with other trusts settled by the same settlor. They should each qualify for their own £1 million allowance. We've also got transitional period trusts. So these are trusts that have been settled post-budget day and before the introduction of the new rules. So the key distinction for these trusts and the later trusts is that there's an unlimited amount of value that can be settled onto trusts which qualify for BPR relief immediately. Obviously, if the settlor dies on or after 6th of April and within 7 years, there is potentially a recalculation required there. Any exits to the trust after 5th of April will reduce the £1 million allowance. So instead of having an exit charge on the value leaving it, the first £1 million can be appointed out tax-free, but then that is a loss for the trust of that allowance in the next 10-year anniversary. Again, another point of uncertainty from the consultation document is we don't know if that's going to be a permanent loss for the lifetime of the trust, or whether or not they just lose that allowance at the next 10-year charge and then it's replenished in the way that it would be for an individual. A single £1 million allowance will apply to transfers made into trust by the same settlor. This allowance is due to be applied chronologically and be fixed for the lifetime of the trust. Again, we're not sure how this allowance will be calculated and allocated to those trusts. Are we basing it on a diminution in value of assets being settled onto the trust, or are we looking at the actual CGT value of an asset? Because those valuations can be quite different, particularly when you're looking at unlisted shares. And then post-April 2025, £1 million allowance will apply to those transfers into trust. So this effectively limits the qualifying assets that can be settled onto trust without an immediate tax charge to 1.65 million. And that's calculated as £1 million attracting 100% relief, £650,000 attracting 50% relief, and then the nil rate band covering the remaining £325,000 that's not relieved by BPR. And then again, as we've seen previously, that £1 million allowance will apply at 10-year charges and to exits. So what should trustees of existing trusts be looking at now before April next year? So trustees of trusts holding BPR qualifying assets may want to consider whether or not they want to appoint any assets out of the trust before April. If they don't do anything, there's going to be effectively that 3% charge on the whole value at the 10-year anniversary, but we have a window of opportunity now where assets can be appointed out with no exit charge. So take an example where you've got a trust with, say, £5 or £6 million of business assets in it. You might potentially want to appoint £1 million to 3 or 4 of the beneficiaries, so they can use their own £1 million lifetime allowance against that, and then it will also reduce the value of the trust at the next 10-year anniversary. But obviously, when you're looking at things like this, you have to look at it in the round. There's the usual considerations around control and commerciality. Is it practical for a business to have lots of small minority shareholders with no one having kind of overall control? You're exposing assets to divorce as well, potentially. Doesn't have that protection that it has inside the trust. And then also, is there going to be an impact on the beneficiary's own IHT position? So even though we're thinking this is a business relief qualifying shares that might fall within the £1 million allowance, it could have an effect on things like the residence nil rate band, which is tapered at sort of over £2 million of value in the estate. Trustees of qualifying interest in possession trusts should also be thinking about doing something now. So let's take this example where we've got Steve, aged 55, widowed a number of years ago. His children are maybe in the late teens, early 20s, and he'd set up this business, Widgets Limited, with his wife. Her share was left on life interest trust to him under her will when she died. We're assuming she died more than 2 years ago, so things like deeds of variation aren't an option anymore. So now Steve holds 50% of the shares in his own right, and the remaining 50% are on a qualifying life interest trust for Steve. And what that means is that the assets of that qualifying interest in possession trust fall within Steve's taxable estate for inheritance tax. So at the moment there's £4 million of value there. 100% BPR would apply to the shares. But obviously post-April, that BPR allowance will be restricted to 1 million, and then the excess is only attracting 50% relief. So this table here kind of shows the position that would arise on Steve's death, where Steve and the trust both have pro rata value of say £2 million. His BPR allowance would be apportioned between all the qualifying assets in his estate, so that means it would be apportioned between his free estate and the qualifying interest in possession trust, with 50% relief on the excess. So Steve has potentially got an IHT exposure of £600,000 on that £1.5 million of value. So he might want to consider removing himself as a beneficiary of that trust, so the trust reverts to a discretionary trust. Obviously by doing so, he would have made a chargeable lifetime transfer of value onto that trust. We're going to assume that he survives 7 years from that, and then this demonstrates how the position will look. Now Steve won't be able to benefit from that trust, but he can still retain control as trustee. He might be sceptical of having his children holding shares directly, for example. So Steve and the trust would each benefit from a sort of 25% discount to the pro rata value, then taking into account the BPR allowance and the 50% relief on the excess. The remaining value is covered by the nil rate band in the trust. Obviously, Steve's estate would also have a nil rate band. Maybe it's set against other assets, but we've potentially abated the taxable value there down to nil or a lot lower. So just a potential liability for Steve there. So how do we expect the tax planning landscape to look like post-April 26? It's going to be a lot more difficult to transfer value out of your estate qualifying for business relief, because we've got this £1 million limit. So unless you're prepared to make pets and survive them for 7 years, then you're going to have to look at other solutions really. So I think we're going to see a rising importance of growth shares. We're already seeing people doing planning with growth shares at the moment. They potentially facilitate more value to be transferred in the long run, because you can use them to cap value in existing structures, such as you might want to try and cap the value in, say, old trusts to less than 1.65 million now, or you may be concerned about your estate continuing to increase in value, so you want to give away the growth. You can potentially give away significant capital value without actually giving up control as well, depending on the proportions of the shares and the voting control. Now, obviously, as a firm, we would do fiscal valuations of trading companies for planning with trusts and things like that. But where we're looking at growth shares, our view now is that you should be obtaining professional valuations from specialist share valuers. Previously, it was quite easy to get HMRC to agree that these growth shares had little value on day one because the hurdle was set at some point in the future. We're seeing a change of approach from HMRC now, and they're saying that there is certainly some value in those shares on day one. So especially where we're considering making transfers of value, where we possibly restricted on the amount of value we can transfer, say, into a trust, we want to be certain that we're not transferring more than we're intending to. And as a result, unfortunately, it's going to mean that planning is likely to be a bit more costly and complicated for clients. But let's have a little look at an example of some planning with growth shares, which try to simplify as much as possible. So here, Phil and Kirsty are married and they've got a trading company called Location Co Limited. The company's worth about £6 million at the moment. and they're expecting it to grow in value significantly in the future. We're not really sure what their kind of future intentions are with the company, but that's one side for now. So Phil and Kirsty both holding 35% of the shares, and maybe they settled 30% onto trust for the children previously. So at the moment they've got taxable value of about 1.9 million in their estate, and the trust holds just under 1.2 million pounds worth of shares. So Phil and Kirsty are concerned that after April, that trust may start to become liable for inheritance tax charges once the value of the shares in the trust exceeds 1.65 million. We're also concerned about further value accruing in their estates, as they'll each be subject to that £1 million allowance. So they've decided they're happy to cap their capital entitlement at £2.5 million each. As I say, they don't really have a kind of a succession plan in place. They don't know whether or not a trade sale is something they're thinking about, but they're happy to cap that entitlement at £2.5 million. So they may consider a class of growth shares that will have, say, 10% voting control. That voting control will generally apply sort of immediately, and 100% of the capital entitlement over an £8 million hurdle. So we're currently at a value of 6 million, the hurdle set at 8 million. So hopefully that will mean that the growth shares on day one will have quite a low value because we're quite a way away from that hurdle. So to have the growth shares professionally valued, and let's say that they are valued at £100,000, that represents the hope value of those shares. And Phil and Kirsty could obviously give those shares away to the children or onto trust and things like that. So once the company reaches, say, £12 million in value, this is how we'd expect the position to look. So you can see the kind of capital entitlement that Phil, Kirsty and the trust have is all over the first 8 million. But then once we breach that £8 million hurdle, 100% of that capital is accruing to the growth shares, which may be held in trust or held by their children. So Phil and Kirsty still obviously holding majority control, 63% collectively, so they're going to only benefit from a small discount on those shares. But we can see that we've capped that taxable value at 2.5 million, which is what their objective was at the outset. And we can see also that the trust's taxable value is capped at just under 1.6. So hopefully there's not going to be any future IHT charges for the trust, and that can just kind of continue almost as a store of capital value. And then, further value will accrue to the growth shares, but hopefully we'll get a large discount on those shares due to the small kind of voting control that they carry. Wills and post-death planning as well. So I think following these changes, business owners and advisors should be ensuring that their wills have at least been reviewed to check that they're still appropriate following these changes. And there's going to be more emphasis on banking that £1 million allowance. So we want to ensure that spouses, where possible, each have £1 million of BPR assets. We might see more discretionary BPR will trusts. So these are generally trusts that are set up under a will, and the qualifying assets will drop into the discretionary will trust on death. So any appointments out of that trust within 2 years are effectively read back into the will, i.e. they're treated as if they'd been made under the will in the first place. So that gives executors and advisors a 2-year opportunity to potentially value the shares and decide whether to take any appropriate action. So considering a situation where you might have £5 million of business assets dropping into this discretionary will trust, potentially you'll appoint £1 million of the assets out to a child or leave them in the discretionary will trust to utilise that allowance, and then you could pass the balance to the spouse to basically defer any inheritance tax charge until second death. Where BPR assets have been left to a spouse on death, obviously that's covered by the spousal exemption, and because this allowance isn't transferable, there's a potential that allowance could be wasted if nothing is done. However, Within 2 years of death, it's possible to do a deed of variation, which again, similar to kind of the discretionary will trust above, where a deed of variation is done, it's kind of read back into the will, treated as if it had taken place under the will, and then that can facilitate transferring the assets to a chargeable person or entity such as a trust or to children to utilise that £1 million allowance that will otherwise be wasted. So I think we've got a few minutes if anyone wants to ask any questions, and then I think in the second half Laura's going to look at IHT planning in the context of a potential business sale, and she's also going to explore some of the kind of clawback provisions and things of the BPR relief under the new rules. Thanks. No questions? Okay, well, we'll take a short coffee break then, and reconvene back for past. If that's okay? Thanks.
Thank you. So the last session today, I'm taking the last session. Thank you for all staying. That's good. I have got things on the YouTube channel, but I haven't mentioned it anywhere in my slides. If you want to look at me on YouTube, I am actually there somewhere. Doing tax, obviously. I'm going to talk about the position where we have clients who are looking to sell their business, their trading business. So as Adam said, we're not doing a one-shot-fits-all, one-size-fits-all kind of tax planning. We have to look at the intentions of the client when talking about BPR, because it may well be that BPR won't be relevant in a few years' time because they've sold their business. So what we want to do is maximise release where we can, but also just understand what's going to happen, what the intention is. Now clearly, you don't always follow all your intentions, but we have to work on what we think is going to happen. So I have a client scenario here where you have a single shareholder called Superb. She's 65 years old and she's been running a business since 2005. So she's held the shares for more than 2 years. It's 100%, well, it's a trading company. It has some investment business in there, about £2 million of investment properties. So we know the rules are that if it's wholly or mainly trading, we're going to get BPR. So this £2 million investment business is not high enough to cause a problem for business property relief. She intends to sell the company in 5 years' time and expects to get 20 million. I've kept all the values the same to avoid confusion in the examples and illustrations. She certainly doesn't have a need for £20 million of proceeds after tax, and she would like to benefit in some way her future generations, whether that's children and grandchildren. And she's very concerned about inheritance tax because, number one, the restriction that applies, even if she dies holding the shares, and number two, she probably won't have BPR in a few years' time anyway because she'll hold cash. She very much intends to live 7 years from any gifts that she makes. Now, if you don't do any planning, we have to understand what the position will be. And to understand what the tax position will be for somebody who doesn't do any planning, we have to run through a few scenarios. And I've made some unfortunate assumptions for Mrs. Perb, which is that she dies in February 2029. She has sold the company, however, for 20 million in December 27, so she'll be sitting on some cash proceeds at that point of time of her death. When we look at the capital gains tax she would pay on the sale of those shares, she would be entitled to BADR because she hasn't used it before, and therefore she'd get £180,000 of tax on the million, and the rest of it's 24%. So all in all, she'd have a £4.7 million CDT liability. Now, strangely, that's actually very good for IHT because it reduces her estate, but not so good because she's still paying tax. So she gets net proceeds of just over 15 million, of which she holds those on death and therefore will pay a flat 40% of tax on those proceeds, giving rise to just over £6 million of IHT. So if she doesn't do anything, and she sells the company on that date and dies at that date, she will have total tax liability of £10.8 million, leaving her family with just over £9 million to pass down. So clearly not ideal, it's a very high tax rate. Clearly no one has a crystal ball, so when people come to us and talk about planning, we obviously ask them about their health and ask them about their likelihood of surviving 7 years, but no one knows when their time is up. So we talk about gifts for IHT generally being a good idea. There's no real downside for inheritance tax on gifts. But there are some downsides for things like capital gains tax. So we need to explain that to the client and say, look, if you die holding the shares, as Adam said, yes, you might, if you were taxed at 20% IHT, let's say, but you will have had an uplift for CGT, and therefore your children can wind up the company or sell it on with no capital gains tax, avoiding 24%. So we need to be mindful of people's intentions, their health, their likelihood of surviving. But what if we were able to just suggest something to them that kind of hedges that possibility of the sale whilst attracting business property relief as well? And I'm going to run through 4 scenarios now to illustrate some of the simple ways of doing things, the slightly more complicated ways, and the benefits of doing them in the more complicated ways in some cases, particularly if you don't know what the outcome is going to be ultimately. Because what we want to do is never put the client in a worse case position than they would have been if they'd done nothing. So the gift options are simply, the really simple one is sell your company, gift your cash. Now that's really simple. So she'd pay her tax as before, leaving her with 15 million or thereabouts. She'll give half away to her children. Survive 7 years, brilliant. She saved £3 million of inheritance tax on that £7.5 million value of cash gifted. However, if she died within 7 years, she's bringing that gift back into charge, potentially at 40%, maybe some tapering if she survives more than 3 years from the date of the gift. The problem with this route is we know, we've got a crystal ball, we know she dies in 2029. So she's waited until 2027, till the company sale, and then she makes a gift then. She's not going to survive the 7 years. Now clearly she doesn't know that, but it's always better to make gifts as early as you possibly can, with the chance of surviving 7 years. The major downside for most of our clients though is not necessarily the tax, it's more the lack of control over those shares. You're giving away, over the cash, so you're giving away £7.5 million of cash to people who maybe get divorced, or they might be drug addicts, or they might have creditors. It's not an ideal situation to give people very large lump sums of cash in certain situations. A lot of people don't like doing that. And also, quite importantly, if you give that £7.5 million to your 3 children, they cannot use that capital to benefit their children without any income generated being taxable on them. So it's not ideal for the future generations. That's if they're under 18. If they're over 18, the grandchildren, it's okay. So we've dismissed that one and moved on to giving shares away to the children. Let's think about giving 50% of the shares away. So yes, it's a pet, so we're really not concerned about reliefs at this stage, because if she survives 7 years, it's exempt from inheritance tax anyway. But we have to consider BPR. We want to assess the company at the time to make sure that if she dies within 7 years, would we get BPR on that gift, reassessing it at death. Now we know in this situation, the company shares will have been sold by the time she dies, so there would never be any BPR on that gift anyway. But we like to understand the position and explain it to the client. The major problem for me on this one is that we know that there are £2 million of assets, property assets, that are not used in the trade of the trading business. They are investment assets. And when we're looking at capital gains tax on making a gift of these shares, there is a specific relief that applies to trading company shares and trading assets, where you can hold over that gain. But there is, number one, first of all, you have to be a trading company. As Tom talked about earlier, we have to look at whether there's any substantial non-trading activity. Now, £2 million out of a £20 million business is not, in my mind, substantial. We do have to check that point. So we're okay on that. We would be a trading business for this purpose. If the investment activities were higher, we may not be, we might not get any relief at all under this holdover. So what that means, if we don't get holdover, the capital gains tax becomes chargeable immediately. But even if we do get section 165, there's a further restriction for any non-trade assets held that are chargeable to capital gains tax. So in this case, we have £2 million of assets that are chargeable assets, and this is a post-2002 goodwill. So we have new goodwill, basically, it's an intangible asset. The company was only set up in 2005, so any goodwill is an intangible. It's not a chargeable asset for capital gains tax purposes. So when we look at this restriction calculation, the revenue have in the legislation, it's chargeable business assets over chargeable assets. That's the element of relief that you are allowed of the gain. We have no chargeable business assets because goodwill is not a chargeable business asset, it's intangible, and we have £2 million of chargeable assets. Therefore, Naught over 2 million is naught, times by your gain, gives rise to no relief under section 165. Now, this is an extreme version of the legislation. This is basically what we understand to be an anomaly that was because of the introduction of the intangible rules. It's not intended. So our view on this would be to go for clearance, non-statutory clearance to HMRC and ask them if this is what their intended action was, their intended outcome was. Because it's not right that you don't get holdover relief in this situation, but the actual legislation says you don't. So the client's not willing to risk that. She also is not happy with giving 50% of the control of the company to her children. Could they say no to a sale? And it's just not right to have children having 50% of your business unless you fully trust them and they may be involved in it. She doesn't have any protection over those shares. Again, divorce, creditors, etc. The CTT on a gift is a big one. Also, any gift that she makes, there's a potential of a clawback because she intends to sell the company. Not that that would put you off making a gift, but it's something to talk to the client about. And last but not least, on the downside is that by giving away those shares, if she dies and the children own the shares, there's no uplift for CGT on those shares given away. The advantages, however, is it's a very simple route, stock transfer form only. Single layer of tax when you come to sell the company, the proceeds flow nicely through to the shareholders. And maybe we can attract more business asset disposal relief limits by the children being involved in the business as directors. And there's no ongoing structure, so no costs or administration of any further structure except the existing company. Alternatively, we could look to give shares away into a trust, which obviously Adam's talked about before. In this case, we've got 50% being given into a trust. It's important we fully analyse the BPR at this stage because it's a chargeable transfer. We're happy that 100% BPR will apply on a gift made before the 5th of April 2026. So we're happy that there's going to be no tax charge on setting up the trust because we also, importantly, have holdover relief when transferring into a trust. It doesn't have to be a business asset in that case. So we're not concerned with any restrictions to relief. Section 260 is the relief you get when you transfer, make a chargeable transfer, i.e. a transfer to a trust. You get section 260 holdover for capital gains tax, thus pushing the gain ultimately to the trustees. So that takes precedence, so you don't even have to consider section 165 at all. She retains 50% as before because she wants her £1 million BPR allowance, definitely, but she also wants some proceeds to spend in her lifetime. She'll retain her BADR limit, which is good, and importantly, the same rate of capital gains tax applies to the trust as to Sue on any value over £1 million. So it's still a 24% rate in the trust as it would be for Sue. So no downside for CDT. So the advantages are, very importantly for trust, and this is what it comes across, is we can do tax planning in a very simple way, but a lot of the tax planning is not really about tax, it's about the circumstances of the client, the control, the protection, and obviously having a trust allows the client to be a trustee of that trust, to have voting control over their shares alongside another member of the family or another trusted person. The trust can be used for multi-generations to benefit grandchildren, future great-grandchildren, etc. It's a long-term vehicle that is very, very flexible, provided it's drafted correctly. And basically it means that you can add beneficiaries, remove beneficiaries, change trustees, make capital appointments out. Anything you want to do in a trust, you can basically do most of the time. And real technical point here is that compared to a gift of shares to an individual, whereby if you died in 7 years of that gift, you would automatically not have your nil rate band allowance available for your death estate because it would have been used against the gift. A strange anomaly of the chargeable legislation for BPR assets is that yes, you do recalculate the gift. You do say what's the position of the date of death? Do I get BPR? Take the nil rate band off. But when it comes to assessing whether you've used that nil rate band, when you come to die, you treat it as not having used it. So basically you're getting the double bite of the nil rate band because of the technicality of how the legislation is drafted on chargeable transfers involving business property relief. So it's a saving of 40% of £325,000 by doing a trust rather than doing a PET. The disadvantages are that obviously Sue can't benefit from this trust in any way, but she's happy with that. She's decided she's giving up 50%. She's not concerned. She's lost the uplift, as in the previous example, but that's always going to be the case when you make a gift. A trust is another vehicle, so don't underestimate, you've got administration of the trust, you've got costs to set it up, you've got ongoing costs. But as long as these are explained to the client and you can mitigate some of these administration costs as you're going along, you can do things as simple a way as possible. Maybe there'll be no dividends paid, for example, or maybe you'll give a right to income to somebody who has the dividends from the trust. All these things make a trust much simpler to manage. You'll have 10-year charges, exit charges. There's also a perceived complexity to trusts because a lot of people don't deal with them. As long as you've got somebody advising you who knows how to do it, then they're not that complicated. As long as they're managed on an annual basis properly, it's when they're left for 5 or 10 years and somebody comes along and gives you a file that nobody's looked at, then that's when there's a problem, normally. And of course, any gift that you make, there's a potential clawback. Reassess the gift. Does BPR apply at the date of death if it's within 7 years? So there's always going to be that on any gift you make of BPR assets. Okay, so sorry, back in the room. We're going through option 3, which is if you've forgotten in a few minutes, is the gift into trust of the shares. So we're going to talk about the tax implications of doing that in a bit more detail, and then we're going to move on to an even better solution perhaps afterwards. So we've got a sale of the company in 2027, as we know is going to happen in December 2027 for 20 million. So that's Sue and the trustees now agreeing to that sale. And what they do with their proceeds is they reinvest them in a portfolio of assets. So they're not going to reinvest in any qualifying business property relief. They're quite happy just to have investments. Now, unfortunately, Sue has not had time to enjoy the benefits because she dies very shortly afterwards in 2029. So we need to understand what the tax implications are as a result of the gift that we've made into the trust and the sale. So we did the calculations before of no planning at all, and we knew that Sue had £4.7 million of CDT to pay. We now look at the position of the trustee sale and Sue's sale. So sale proceeds are split equally, 50% each. Sue retains that BADR limit allowance, and therefore her tax is slightly lower, just 2.34, giving rise to net proceeds to her of 7.66 million, £60,000 differential between the trust that is ended up with net proceeds of 7.6 million. So we've got no downside for CGT because it would only be £1 million allowance anyway. The BPR position on the death in February 2029 needs to be looked at. So we look first of all at the gift that was made in 2025. So the value of the gift is important to understand. We talked about diminution in value, and this is where it illustrates that the value of the diminution in value is much greater than the actual value of shares given away. So she had 20 million in her estate before any gift. She's now got 50% of the shares left after the gift, which is a 10 million pro rata. She would attract a 15% discount on a 50% holding, giving rise to her retaining 8.5 of value only when you take into account discounts. Therefore, the value of the gift is the difference between what she had before and what she's got afterwards, being 11.5 million, which is obviously greater than you would expect being £10 million shares. So, fortunately, BPR applies at the date of the gift, so we're not concerned about that £11.5 million value at this stage because she's going to get 100% relief on the transfer into trust, so no tax on the chargeable gift. However, she has died within 7 years of that gift, and the shares have been sold, which is the important point. So we have to reassess the gift and say, do the trustees attract BPR on those shares at the date of death? Well, no, they can't because they don't hold the shares anymore, so the qualifying condition is not met. They have cash proceeds. So the value of the gift is brought back in, and 11.5 million, and Sue hasn't made any gifts beforehand, so she gets the £325,000 allowance against that value of the gift. 11.175 is taxable. At 40% would be 4.47 million of tax, but she survived more than 3 years, between 3 and 4 years, so there was a 20% taper on that IHT liability. So therefore, the trustees, as the donees, will be liable for that IHT liability. They have got £7.6 million of net proceeds from the sale, and they can afford to pay that £3.5 million of IHT. It's not ideal, but they can afford to pay it in cash. And they'll be left with just over £4 million of cash. So again, still quite a high effective rate because the gift has failed. I'm not going to go into Sue's position because we're going to go into a bit more detail of a different better option and go through Sue's position and the trust's position as well. So a better option, and we've done this quite recently with another client, is that if possible, and again I appreciate this isn't always possible, can we have a commercial and business reason why inserting a holding company on top would be the benefit of the trade? Now we have situations where this has worked, so we insert a holding company on top of Shakers called Movers Limited, which Mrs. holds 100% of to start off with. She then transfers 50% of these shares into trust and attracts BPR on that. The reason she doesn't have to hold Movers shares for 2 years is that they stand in the shoes of Shakers shares. So it's as if she's owned them for the same amount of time. So she's qualified for the 2-year ownership period by virtue of that relief there. So provided she transfers those into trust before 5th of April 26, I appreciate you've got to do holding company, then a transfer before 5th of April, but it is doable. She gets a CDT holdovers before, and she gets 100% BPR as well. The important point there is she had 100% of the shares start off with, so it's a holding company of a trading group. It owns 100% of Shakers. So, what's the position for the sale of Shakers? Well, we know that the sale happened more than 12 months after the movers acquired the Shakers shares. So we should qualify for SSE, provided all the other qualifying conditions are met. And therefore, Movers Limited will sell the shares in Shakers and not pay any corporation tax. So they will receive £20 million of proceeds in Movers Limited. That means that gross proceeds are available to invest in that company for the benefit of Sue and the trustees. And the idea is we wouldn't want to liquidate that company because we would get 24% hit or thereabouts on liquidation. So the idea is it's kind of like a family investment company with Sue and the trustees being the only shareholders. Then we assess the gift right T. So does BPR still apply at the date of death on the transfer of Movers Limited shares into trust? Well, yes, it does, strangely. And you would think not, but it does, and there isn't a clawback of that relief. The reason it qualifies is that because the legislation, and I'll come on to the actual wording shortly, is that the only qualifying conditions for shares are that the shares are retained by the donee. So provided they qualified at the date of the gift, that's fine. You don't have to be a trading company when you reassess the date of death. So that's a really important point here. In the previous example, we had no shares, they had been sold. In this example, the trustees still own the shares. They don't qualify for BPR in their own right, but for the gift purposes, they retain that qualification, so there's no clawback on that gift into trust. So looking at that in figures terms, we know the value of the gift is 11.5, the same as the previous illustration, but BPR does apply. She died in 2029, so it does apply, but it's at the new rates of relief. So we're not getting 100% exemption, so we are going to have some tax, but obviously it's much lower than we would have hoped. So we have a value of 11.5 million, a £1 million allowance applies, giving £10.5 million of chargeable gift. Half of that's relieved by the 50% relief, giving rise to 5.25 million of chargeable transfer, less than no rate band, just under 5 million. Taxable at 40%, 1.97, but then with the taper again as before, gives us 1.576 of tax. So the net value in the trust, and I appreciate this is not cash available to distribute or without further tax implications, but the net value sitting in the trust is £10 million of shares, less the IHT liability that will have to be paid, is 8.424 million. So compared to option 3, where we only had £4 million of value in the trust, we've now got 8.4. However, slightly misleading, because of course we do not have the cash in the trust to pay that tax. The trustees hold shares of the investment company, so we don't have the ability to just take money out of the company without tax implications. So how do we pay that tax? Well, first of all, and I haven't written on here, first of all, if you have unquoted company shares, then you do have an instalments option. Not without interest. If it was qualified for BPI, you would have interest relief. but you should have interest on that. But you can, instalment options possible, provided you satisfy a number of criteria of the percentage you own and things like that. But generally in this case, you probably would get the instalment option. But let's say the trustees want to just get rid of this liability in one go. They would probably have to take a dividend from the company to pay that IHT liability. And obviously there's a cost of doing that with that magnitude of tax to pay. So trustees tax at 39.35% on a dividend, you have to pay a £2.6 million dividend up with £1 million liability. So there is an extra cost to doing this, but we've worked out we were £4.4 million better off before. Even with that £1 million income tax payable, we're still £3.4 million better off than option 3. Now, it may be that the personal representatives agree to pay that liability if the trustees don't pay within 12 months. It might work out for the family because it might be that all the beneficiaries are the same in the trust and in the estate. So, potential option where you might not have that tax liability. I defer to private client solicitors on that matter. I hate the liability and burden when it's on paying tax, but possibility. Could they do a company purchase of own shares? Yes, they could, but they wouldn't get a capital gains tax treatment because they're not a trading company. So maybe they could buy back. We want to keep the shares in trust though. We don't want to do that. We want to get a dividend now if possible, because that's the best option of retaining value in the trust, because the trust is the one where we want the value to grow, not in individual people's estates, because it's a lower rate of inheritance tax ultimately. But what about for CGT? Well, as Tom mentioned, you can't just stick a holding company on for any old reason. You have to have a business reason and what's acceptable. We have had cases where we've got Sue who's retaining 50%. She might want to reinvest back in the company, sort of de-risk the cash coming out into a holding company, but lend it back in. Things like that would probably work. The fact that she's got such a big interest and she's a retained shareholder might help with that. We've got to hold the shares for 12 months. Movers have to hold shaker shares for 12 months, otherwise we've got a worse position in that we have corporation tax on the sale of shakers, which will give an effective rate of 43% when we take the profits out of the holding company. We will lose BADR for Sue because the intention is not to liquidate Movers, because the idea is to keep it going as an investment company where you can invest that £20 million in it. So we are going to lose that £60,000 benefit, but in the scheme of things and the ability to defer that tax, that's a small price to pay. And again, we have a loss of uplift on the shares that Sue was giving away, but we're not really concerned because we have a deferral of that CGT liability for many years, possibly. Again, for IHT, important considerations. This is a really important one. To obtain this BPR on the gift on death, the trustees must hold on to those shares for 7 years, or until Sue dies if that's earlier, which in this case it was. So our advice always to trustees receiving BPR shares is do not appoint them out within the first 7 years. Keep hold of them without doubt, because otherwise if they die within that period and you don't hold them anymore, you're never going to get BPR on that gift. And this is the point I made about the legislation strangely saying that the mover shares do not have to be trading at the date of death. It basically says that Section A says that the assets still need to be held by the donee, and that's the case for all BPR assets. If you give, some manufacturing item to a son, the son must hold that item at the date of death for it to qualify for BPR. For shares, you do not, so it says, except the extent that the original property consists of shares. The original property would, apart from the 2-year rule, have to qualify for BPR. So it says, except the extent it consists of shares. So any other interest in a business, like a sole trade or a partnership interest that you give away, that has to continue to be trading at the date of death within 7 years. The shares do not have to be trading company shares. And the transfer, of course, must be made before 5th of April, otherwise we are restricted on the value that can go in. And don't forget, there cannot be a binding contract for sale in place at the time of the transfer. So, let's just remind ourselves, this is actually a failed gift. So all these examples I'm giving you now are of her dying within 7 years. So there's still big savings remaining if she dies within 7 years. So don't forget that. We'll come on to this final slide which shows you the tax savings if she survives 7 years. We just want to reiterate that. So Sue's position is that she would have half the company in her estate on death. She will attract a 15% discount because she only has a 50% interest. So her IHT on that £8.5 million of value would be £3.4 million. She has other assets to cover that IHT liability, so we don't need to liquidate the company to pay that liability. or get a dividend out. She has the uplift for CGT on the market value of the assets at death. Now, because she split her interest between her and the trust, the market value of those assets is 8.5 rather than the 10 million. So that element of discount that we got for IHT, that will be subject to capital gains tax at a later date, because that, you know, the market value uplift has only gone to 8.5 rather than the £10 million pro rata value. But we're not concerned, because that's a future liability and may happen when CGT rates are 10%, who knows. The trustees' position is that they have that 1.576 liability that we talked about before. No uplift because nobody's died in this position. The trustees own the shares. We have a future CGT liability of 10 million at 24%, so £2.4 million future liability of CGT. And we've got that income tax potential liability to pay the inheritance tax. And of course, let's not forget, we do have ongoing 10-year charges in the trust on a substantial value, which we can't forget about. So overall, in sort of tabular form, you'll see that bringing back the no planning option, she's got her family have a £10.844 million liability on the sale and the inheritance. Whereas under option 4, yes, we have an £8.756 million liability on a failed gift, died within 7 years, but we have cash flow advantage of 4.85 million, because of course we're not paying that CGT liability ever on for a long, long time, hopefully. And of course we can potentially avoid the income tax maybe as well. So remember, that's if the gift fails. If it's a successful outcome, it's important to know if she survives 7 years what the outcome is. We've gone from a £10.8 million liability to a £6.16 million overall liability, but again, 2.76 million of that is not payable for many, many years, if at all, to keep the company going. So, of course, the people who inherit the shares from Sue may die owning the shares and wipe out that small liability. The trustees may appoint out those shares to other shareholders who hold them at death and may wipe out that liability. So there are ways that liability may never occur in the future, but it's always better to defer if possible. Exit charge, by the way, is probably likely to be about £500,000. So again, not a small liability and will need to be funded somehow, but hopefully, you know, with all this extra cash sloshing around, they'll be able to afford to pay the 10-year charges. So as I would say, it's more about sort of planning for every eventuality. What's the best scenario should this happen, should that happen? Certainly not putting them in a worse position if something happens we weren't expecting. Certainly not putting them in a worse position than doing no planning at all. And making sure the clients understand what are quite complicated issues and explaining it fully to them, which is why when we prepare inheritance tax reports, we do a full and comprehensive review and explain everything, because coming back in 10 years, and why did I do that? Well, this is why you did that, so you know now. But has anybody got any questions?
Oh, yes, yes.
It's not so much about this bit, but maybe about pensions. People who
Oh, right, okay.
pension policy.
Yes. Yeah, well obviously what we're doing is we're including them in the value of the estate and saying this will be taxable in 2027. We are taking each on a case-by-case basis. So if somebody's got a very valuable SIP, some people got 30 million SASs and things like that, we are then talking about what you should be doing now, because to get that value down is quite difficult. Some people are thinking of going abroad and stripping it out. That's for people who are very mobile and quite wealthy to do that. We're talking about switching the planning round from previously it was leave your pension alone, get rid of all your other assets. It's now get rid of your pension, use your pension, keep your other assets, because you've got a double liability on your pension potentially when you're over 75, you die over 75. So it's just assessing really what the circumstances are of the client, how old they are, whether they will have an income tax charge on the beneficiaries based on their current age, whether we start doing plan a little bit later because they're getting to 75 and therefore they should start planning for that eventuality. But what we certainly don't want to do is start stripping out very large values from pensions and they die next year, and then you put them in a worse position than they were before. But in one case, I've got this lady, if she wants to get this pension down to any acceptable level, we'll have to start taking money out now. Maybe flexi access drawdown and then giving gifts out of income, it's one option. It's just a hybrid, and to be honest, we're not very used to dealing with pensions because it's always been a financial advisor's remit. So we have to work alongside them, because we don't know the ins and outs of the pension rules enough to be able to properly advise. So we want to do that really. It's certainly not one solution for everybody.
Right, okay.
Okay, well, thank you very much to everyone for coming. Hope you got something out of it. So hopefully come to the next breakfast seminars we'll do, probably next time, probably breakfast ones? September, so look out for your emails. Thank you.